Welcome to The Explainer, where we break down some pretty big topics. And today, we're going to decode a financial blueprint used by some of the wealthiest people on the entire planet. Let's get right into it.
All right, so let's start with a puzzle. This is something that's been in the headlines for years, and honestly, it just doesn't seem to make any sense at first glance.
Right? You see these big names, think Elon Musk, Jeff Bezos, and you hear they're taking an official salary of just a single dollar. Some of them take nothing at all. And yet, you see their lifestyles. They're not exactly clipping coupons. So what gives? How is that even possible?
Okay, to really get this, we've got to look at two completely different financial worlds. Over here, on one side, you've got your typical wage earner. They make a salary, say 100 grand, and they pay a pretty big slice of that in taxes. We all know how that feels. But then you look at the other side, the asset owner. Their official income, basically nothing. And their income tax bill, also nothing. That is the whole game right there.
And look, the big secret here? It's not some shady, illegal scheme about hiding money in offshore accounts. Nope. It's all about a really fundamental difference in how our system looks at the money you earn versus the stuff you own. See, for most of us, our financial lives revolve around income. Your salary, your wages, that money that shows up in your bank account from your job. And every single year, the tax man comes calling on that income.
But the super wealthy, they play a different game. They focus on wealth, specifically something called asset appreciation. This is just the value of their stuff, their stocks, their real estate, going up over time. But here's the absolute kicker. That growth, all that on-paper profit, it isn't taxed every year. The tax only comes due if, and it's a big if, they decide to sell. And that one little distinction, it opens the door to this incredibly powerful three-step strategy. Some people have given it a pretty blunt nickname: buy, borrow, die. And this is the master plan for living a massive lifestyle while telling the IRS you barely made a dime. All right, let's break it down. Step 1, buy. Now, the concept is super simple, but the impact is, well, it's huge. It's all about getting your hands on the right kind of assets. So the first move on the board isn't just about hoarding a giant pile of cash. No way. It's about taking that cash and putting it into things that are just going to grow in value all by themselves. Basically, making your money work for you while you sleep. And what are we talking about here? Well, think big. Company stock, huge real estate portfolios, priceless art collections, you name it. These are the engines that just churn out more and more wealth. Okay, now for the really clever part, the magic trick. How do you take all that value that's just sitting there on paper and turn it into cold, hard cash you can actually spend, without selling anything and getting hit with a massive tax bill? It all comes down to one simple but incredibly powerful statement. A loan is not income. The government doesn't see money you borrow as earnings, so it's not taxable. And what does that mean in practice? It means the tax rate on the cash you get from a loan is a big, fat zero. It's a completely tax-free way to get cash in your pocket. So think about it. Instead of selling off their stock and paying a ton in capital gains tax, they just walk into a bank, they say, hey, look at my massive portfolio of assets that's worth billions. They use that as collateral, and they walk out with low-interest loans. And that's the money they use to live on. Tax-free. All right, on to the last step in this playbook. And this one might be the most mind-bending of all. It's all about what happens to that mountain of wealth and all those loans when you're gone. Okay, so normally, right, when you sell an asset that's gone up in value, you owe capital gains tax on the profit. It makes sense. And if your kids inherited that asset and then sold it, they'd usually have to pay tax on all that growth that happened over your lifetime. But, and this is a huge but, there's this little rule in the tax code called the stepped-up basis. You can almost think of it like a giant tax forgiveness button that gets pushed for your heirs the moment you die. Let me give you an example to make this real. Let's say you bought some stock for $1 million. You hold it your whole life, and when you pass away, it's worth a cool $20 million. Now, without this special rule, your heir would be looking at a tax bill on that $19 million in profit. Ouch. But with the stepped-up basis, everything changes. The cost for your heirs isn't the $1 million you originally paid. No, it steps up to the current market value. That's the $20 million. So what happens if they sell it the very next day for $20 million? Well, their cost was $20 million. They sold it for $20 million. Their taxable gain is zero. Poof, that entire $19 million of growth is legally erased. It's never taxed. Ever. So, when you put it all together, buy, borrow, and die, you start to see the full picture.
It's an elegant and, let's be honest, pretty controversial financial strategy.
It's a beautiful system, really. Step 1, you buy assets that just grow and grow. Step 2, you borrow against that untaxed growth to get tax-free cash for your lifestyle. And the grand finale, step 3, you die. And all those decades of gains are legally wiped clean for your heirs. It's how massive fortunes can be passed down from one generation to the next, almost completely untouched by taxes.
And all of this kind of leaves us with one big final question to chew on. Is this whole buy, borrow, die thing a feature of our tax system? Maybe it's there on purpose to encourage people to invest for the long haul? Or is it a bug, a giant loophole that lets incredible amounts of wealth escape taxation entirely? The answer to that question, well, that really shapes the financial world that every single one of us lives in.